In this video, I'll tell you everything you need to know about debt, and we're starting right now. Hey guys, Elliot here. So you're watching this video because you're probably concerned about debt, and surprise, surprise, you're not alone in this. With many people carrying excessive auto, student, credit card, and other debts, there's a ton of anxiety about this specific topic. So let's jump right in and talk about it. And be sure to stick around, as later in the video, I'll share some ideas about how to avoid getting into the various kinds of debt in the first place, because prevention is always better than a cure. Now, the place to start is a few definitions and to mention the different kinds of debt. Generally, there are two types. The first is secured and the other is unsecured. Secured debt is backed by collateral, not just the creditworthiness of the borrower. When you take out a secured loan, it has lower interest rates since the lender has a lien on a physical asset to repossess in case of default, making these types of loans less risky to the lender. Two common examples of secured loans are mortgages and car loans, which are secured by home and the vehicle respectively. Now, unsecured debt is not backed by any collateral and is based strictly on the creditworthiness of the borrower. These types of loans are considered riskier, and the lender generally charges higher interest rate to offset this risk. Some examples are credit cards, private student loans, and most types of personal loans. Now, another thing to mention, and this may surprise you, is that not all debt is considered bad. There is such a thing as good debt, and it allows you to acquire something that will either grow in value or generate income and help increase your net worth. This debt usually has lower interest rates and is sometimes secured by collateral. Mortgages, business loans, and student loans, in most cases, are examples of good debt. Bad debt, on the other hand, allows you to acquire something that will either lose value or will not generate any income and thus lower your net worth. This debt usually has a higher interest rate and is rarely secured by collateral. Credit cards, payday loans, and most car loans are examples of bad debt. Okay, so you're a debt terminology expert now, and we can really get down to the main topic of how to get rid of it. And as we do, please be sure to subscribe so I can keep bringing you these personal finance and investing videos. So what techniques can you use to get rid of debt? Here's a full list, and it includes 5 methods: debt stacking, debt snowball, balance transfers, and 2 types of debt consolidation. Let's go through these one by one. Debt stacking and debt snowball are related, and both are just simple approaches to paying off debt. These techniques are commonly suggested by financial advisors, including Dave Ramsey, who actually coined the term debt snowball. The idea here is to rack and stack your non-mortgage debts and pay them off in a specific order. With debt stacking, you arrange them in the order of interest rate from highest to lowest, and with the snowball, you arrange them in the amounts owed from lowest to highest. In both cases, you then pay as much as you possibly can on the top debt in your list and just support the rest with minimum payments. When you pay down the top debt, you move on to the next one on the list. To really make it clear, here's an example. Let's say you have 4 debts: auto, student, credit card, and tax, each with its own amount owed and its own interest rate as seen right here. For debt stacking, you would arrange them like this, with the highest interest rate at the top, and sink all of your efforts into paying that off, moving on to the rest once that's done. This approach makes the most mathematical sense and will save you the most money since you're going after the highest interest rate first. For the debt snowball, however, you would rearrange the same debts like this, with the smallest amount at the top of the list, and concentrate on that debt first before moving on to the rest. So why do financial advisors, including Dave Ramsey, suggest this approach even though it's not as efficient? Well, the reason is psychological. For many people, if they quickly eliminate a small debt, they will feel encouraged to keep going and will stick to the plan. Which method you end up using is up to you, but you should know the pros and cons of each. Okay, next let's talk about balance transfers. This is a credit card payoff technique and one of the most effective ones out there. If you have credit card debt, the biggest issue you'll face is the astronomical interest rate that most cards charge due to the fact that it's unsecured debt. Balance transfer works by briefly giving you a break from the interest rate so you can pay down the principal, and is based on the fact that credit cards give new customers a temporary window, typically 12 to 15 months, where they don't charge any interest if you transfer another card's balance onto theirs. So how do you actually do a balance transfer? It's pretty simple. You just apply for a card that has a generous 0% APR offer and then transfer your balance either automatically on their website or with customer service rep. There may be a fee, typically 3% of the transferred balance, but you will save far more in interest over the long run, so generally this is a good idea as long as you actually buckle down and pay off that balance. Sometimes people don't, and then you have to repeat this process with another card. Okay, now let's talk about debt consolidation. This is another effective way to pay off debt faster because you're basically getting rid of the high interest debt and consolidate it into lower interest debt. There are two distinct ways you can consolidate. The first is with a personal loan and the other is with your home equity. With a personal loan, things are quite simple. You just research what banks or credit unions are offering and find a personal consolidation loan rate that is lower than the rates of your debt. You then roll them all into this new loan and make new payments. This is good because you can both lower the interest rate and also combine numerous debt and loan payments into one convenient payment. Now obviously you have to do your research carefully as this is only effective when the new loan rate is lower than the one you already have on your current debt. Now the second consolidation approach is strictly for homeowners. You can use your home's equity and take out either a HELOC or a home equity line of credit. Both are roughly the same in the general approach, with the main difference being that HELOC is a flexible line of credit which you can use or not use based on need, while a home equity loan is an actual fixed sum loan. Both are given to you by a bank based on a percent of your current home equity, which is of course the value of your home minus what you still owe on it. For example, if your home is currently worth $600,000 and you still owe $200,000, your equity is $400,000. If you request a HELOC or home equity loan at 25% of equity, then your maximum available credit line or loan is $100,000. As always, you have to be careful with these types of loans as your home is the collateral and it will be in jeopardy if you can't pay these loans back. If you are conservative and careful on how much you borrow, however, these home equity loans are a great way to pay off high interest debt as typically the interest rate on these is much lower. Okay, so those were some techniques for paying back debt. What about not getting into debt in the first place? This topic is really the other side of the coin, and I would argue it's even more important because, as I said in the beginning of the video, prevention is way better than the cure. So as promised, let's discuss how not to get into debt in the first place. Now, there are many different types of debt out there that you can find yourself owing, but let's go over the 6 most common ones and list out ways you can avoid racking up any of them. The 6 types of debt I'll cover are mortgage, auto, student, credit, medical, and tax debt. Pay close attention as there are a lot of good ideas here. So first up is mortgage debt. There are a few quite obvious ways to lower this debt even before you actually purchase the property. Some of those include getting a smaller and less expensive house, putting down 20% to avoid private mortgage insurance, and shopping your mortgage loan carefully, especially if you have an excellent credit. If it's doable, get a 15-year, not a 30-year mortgage, and maybe even consider what is called an all-in-one mortgage, which is a very interesting approach, and I have an entire video on it which you can check out in the description below. Now, if you already purchased the property, there are still possible ways to save and lower your debt. You can refinance if there's a lower interest rate available, shop around for lower home insurance plans, and even appeal your property tax assessment, as those can sometimes be incorrect. Finally, you can cut down your mortgage payments by taking on roommates or using Airbnb to rent out rooms if you have a few spare ones. Next up is auto loan debt, and this is a big one for many people as car prices have risen quite a bit in recent years and people do tend to splurge more than they should on vehicles, resulting in a massive debt load weighing them down. The most obvious way to lower auto loan debt before even purchasing a vehicle is to look for a smaller and less expensive one, and do not buy new. Instead, get a historically reliable 2 to 3 year old vehicle and let someone else take the depreciation hit. If you're getting a loan, shop the rates carefully, especially if you have excellent credit, and always line up your financing before you go shopping. If you already have a loan, you can refinance if a lower rate is available. And don't forget that insurance savings is part of auto debt, so shop insurance carefully and slow down to avoid speeding tickets, which will save on gas costs as well. Finally, just like with a home loan, you can occasionally rent out your car on sites like Turo.com, and you may be able to cover part or all of your monthly payment if you do this. The downside, of course, is that someone else will be using and possibly abusing your car, but if you work at home or have a second car you don't use often, renting it out may be a great way to offset the car payments. Okay, next up is student loan debt, a topic that's been in the news in 2023 as the debate about federal student loan debt forgiveness went all the way to the Supreme Court. So the trick with student debt is to first realize that there are a lot of sources of money that you can look into before even trying to take out a loan. This list of available money includes academic and sports scholarships, government and private grants, and especially for graduate school, company tuition reimbursement available for many government and some private company employees. There's also the military path to a free education, but that is obviously a major life decision that I can't really cover in this video. One of the best ways to save a ton of money in college is to not go to an expensive one. 2-year community colleges, while varying in quality, are actually a really good deal if you make the most of what they offer, and every college-bound high school senior should at least consider consider attending the first 2 years of a 4-year education at a local community college. You're just taking basic college courses anyway as a freshman and sophomore, so why overpay for them? For upper division, whether you enroll after a community college or directly after high school, the way to save money is to go to a state university, as their tuition is far lower since they are taxpayer supported. I went to a very expensive elite private university for my undergrad, and I sort of regret it as I was stuck with years of student loans to pay off, and to be honest, I could have gotten a job just as easily after graduating from a lower cost public university. Now, what if you don't qualify for grants or scholarships and you have to take out loans to pay for tuition? Well, like with any loan, shop around for the best rates, and if you're already out of school, always keep an eye out on refinancing if the available rate is lower. Government loans are typically lower interest rate but are often needs-based, so not everyone will qualify, but if you do, they are preferable to private loans. And unlike private loans, they can be eligible for deferment, forbearance, or cancellation, though as I mentioned earlier, this has been mired in some controversy lately. As a side note, if you have young kids who you expect will go to college one day, it's a really good idea to open a 529 educational investment account, and I actually have a video on those in the description below. Okay, we're on the home stretch here, and if you like what you're learning, please do like and subscribe. It won't lower your debt, but it will make the YouTube algorithm happy. Next on the list is credit card debt. We already talked about a great way to pay off credit card quickly, but as far as not ringing it up in the first place, the best advice is really to just have one card, spend within your means, don't carry a balance month to month, and don't put anything on a credit card that you don't have the cash to pay for down the road. What about medical debt? This one's a very unfortunate topic, as medical debt is one of the primary causes of bankruptcies in the US. The best advice is of course to obtain medical coverage either through an employer or purchased independently. Even some coverage such as catastrophic only is better than none. There are options like the Affordable Care Act, so if you really do your due diligence, you should be able to find some sort of coverage even if it's not ideal. Obviously, you should not schedule elective surgery until you have coverage, and if you want one more idea on how to avoid medical debt, try medical tourism. Traveling internationally to obtain medical care, typically to Mexico in the case of most US residents, is a controversial topic, but it worked for a lot of people. Both procedures and medication are far cheaper south of the border, but of course you have to make sure the quality of the care is up to standards. Sometimes American doctors set up shop in Mexico as there are far less expenses and red tape for them to do so, and they pass the savings along to their patients. Okay, the final debt to mention is tax debt, and this really applies to workers who are independent contractors and must pay their own federal and state taxes, as none are withheld. The trick here is to make quarterly estimated payments and not try to pay your entire tax bill when it's due, as odds are you may not have enough cash laying around to take care of it. Set aside a percentage of your gross income every time you get paid and store it in a high-yielding money market account so it can rack up some earnings, and then be sure to pay an estimated amount to the state or IRS on a quarterly basis. Finally, to finish up the video, what if you need some professional help with your debt or just some additional advice? There are a number of government and nonprofits out there that can give you debt advice and offer various types of assistance. I listed them right here, so be sure to pause the video to write these down, and I'll also put them into the description. There are also for-profit debt relief and debt negotiation companies out there as well. Here's a list for you to check out, and these will also be added to the description below. Okay, I hope you really enjoyed this tutorial on all things related to debt, and you got a lot out of it. Please do consider subscribing if you haven't yet, and I will see you in the next video.